So hello and a warm welcome. I'm Carl Turner, the co-founder of Expat Tax Thailand. And the purpose of this webinar is really just to provide you with accurate, up-to-date information on how pensions are taxed in Thailand, really to help individuals make better informed decisions with their Thai tax filing obligations so they can understand the rules and make their own decision how they move forward. We're here to help. Feel free to put any questions in the Q&A box and we'll get to those by the end of the webinar. So the areas that we'll go through today, we'll go through the Thai income tax rules and the recent announcements. We'll discuss what is assessable income, what are the filing requirements, how do double taxation agreements work, what are the allowances, deductions, and tax brackets. We'll go through a few case studies and then discuss how common reporting standards and automatic exchange of information means that Thailand has the information to hand. So who will benefit from watching this webinar? So two types of people. One, for individuals that are already living in Thailand that are receiving or planning to receive an overseas pension income. And for those that have not moved yet to Thailand that are looking to relocate so they can understand how pensions are taxed. So if you do have any questions, you can go onto our website, expattaxthailand.com. We have a frequently asked questions page that has hundreds of questions and answers on there for a lot of the common questions. And just a quick disclaimer before we start, anything that's provided in this presentation is not to be taken and acted upon. If you do need to act upon specific advice, it's important to seek professional advice before acting. So what's actually been announced? So these are the key timelines that are important to look at. So 15th of September, 20th of November, and the 1st of January 2024. So on the 15th of September, there was a departmental order issued by the Revenue Department. And on the 20th of November, there was another announcement which showed that any cash in the bank from previous years could be remitted in the following year. So the September announcement that was actually published in the Royal Gazette in October. And this actually set out how foreign source income is taxed in Thailand. All it did was overrule a previous ruling set in Thailand. So what does that mean? It went back to the original rule. So it's not a law change. It's just a departmental instruction to how the revenue departments actually look at foreign source income. So it's a real big impact for people that are Thai tax residents who bring in overseas income. Today we're actually discussing mainly the pension income. So that's what we'll focus on. And Thailand's a remittance tax basis, remember, at the moment. So what does that mean? It means if funds are transferred to Thailand, this is classed as remittance. So transferred, remitted, they are the same sort of words what we use quite often. And then that's potentially taxable if it's remitted to Thailand for a Thai tax resident. So what are the key dates that we need to look at? So the tax year starts on the 1st of January every year. So we're already well through the year. The end of the tax year is 31st of December. And the last filing date for the current tax year is the 8th of April next year. So they're the key dates to look for. So the tax year started and the rules changed on the 1st of January 24. And the tax year ends on the 31st of December 24. There's actually another announcement by the Revenue Department and a document that was produced in July this year, just explain how foreigners living in Thailand pay tax. And this was focused on PN 90 and 91. So this was focused on pension income and capital gains, investment income, rental income, these types of assets. So the Revenue Department actually produced another document, and they've actually produced quite a bit now, and they've had a few Q&A sessions. So it's quite clear how this works now with the tax credits and how this will be implemented. So who will this new rule changes affect? So anyone who's in Thailand 180 days or more in a calendar year, that's the definition of a Thai tax resident. That doesn't have to be all in one row. in one go. You can leave and come back if you're 180 days or more in a year, not consecutively. It can be any, come and go as you please. Then you are a tax resident. It affects most visa holders. So marriage visa, retirement visa, business, elite, smart, the new DTV visa. The only exclusion is the LTR visa. So that's got higher qualifications for the wealthy pensioner, but there are some exclusions for that. It could potentially help some high net worth individuals who would like to remit in foreign source income. There are quite hard stipulations to meet, but it has got a royal decree. And with the current situation, it is suitable for the current rule changes to remit in foreign source income. We have got a webinar on that specific topic. If you'd like more information, then you can feel free to reach out. So let's get on to what is taxable in Thailand. Let's look at the 8 categories on the revenue code, on the section 40 of the revenue code. The one that we're really interested today is section 1. It's section 40, part 1, which actually includes pension income. And this needs to be filed on a PND 90 tax return. And that needs to be filed in April, the following tax year. So, and then other areas which are quite interesting that I've highlighted is number 4, which is actually for investments, property sales. And then number 5, which is rental property income. And 8 is everything else like trusts, for example. So now we know what is taxable. Let's have a look what isn't taxable, because these are some of the common things that we get asked. So any asset that isn't transferred into Thailand or spent in Thailand, if it's left overseas. So Thailand's a remittance tax basis, remember. So at the moment, it's not taxed. You're not taxed on your worldwide global income. It's only on remittance. So for this current year, then we know that if assets aren't transferred or remitted to Thailand, then they are not assessable income or taxable in Thailand. Also, any remitted income from previous tax years when they weren't a Thai tax resident. So if you've got cash in the bank, that leads on to the next one. And the balance as of the 31st of December 2023, this amount can be remitted into Thailand anytime in the future. Any original capital, so if you've got investments or property that haven't made money, these can be remitted into Thailand because if they haven't made a gain. Inheritance, so foreign inheritance is not assessable income in Thailand. Gifts, so potentially gifts fall under gift tax rules. I put on there, it's quite complex and it's not really ideal for tax planning to use gifts, but it's an area that's not assessable income. Loans, if there is a term and you meet the stipulations in terms of having a set income, the percentage cut out, then that might qualify. And transfers to Thailand for non-Thai tax residents. So if someone sends funds to Thailand and they're not a Thai tax resident, then that's not assessable income either. So let's get on to pensions. Let's talk about what isn't taxable as well. So let's talk about anything that's sent to Thailand, anything that's sent overseas, so a pension that's paid overseas, if it's not brought into Thailand, then that's not assessable income. If you've had income paid into an overseas bank account in previous years and you've got a cash account in there and you bring in that cash balance, not new income from the 1st of January 2024 onwards, but the old income, that can be remitted without any tax. And again, transfers to Thailand for non-Thai tax residents. So if you're less than 180 days and you do receive a pension overseas, you can bring that into Thailand because you're not a tax resident. So who actually has to file a tax return? So anyone who brings in foreign source income, so this is investment capital gains, with the main focus of this webinar is pensions. If you bring in rental income from property, dividends, property sale, anything like this, this is classed as assessable income. Now, depends on what kind of assessable income you bring in to what are the limits that you need to file. So if you bring in over 240,000 Thai baht as a married joint filing couple in Thailand of pension income, you have to file a tax return regardless if you have tax to pay or not. And if you're an individual, so you're not married, or your spouse has an income, then you can bring in 120,000 Thai baht of pension income in a year before you have to file a tax return. If you're over this amount, you need to file a tax return. It doesn't mean you necessarily have tax to pay, but it's a legal requirement to file. Then also the next step down is actually for other types of assets. So if you've got investment capital gains, you're bringing that in, property rental income, dividends. Well, this has a lower limit. So if you're bringing in more than 120,000 as a joint married filer, you have to file a tax return. And if you're bringing over 60,000 as an individual that's not married, you have to file a tax return. This is only on the gains. That's not on cash in the bank from previous years. So it's only on assessable income. So regardless if tax is paid in another jurisdiction, so if you've already paid tax elsewhere, then you may still have to file a tax return. And just because you've had paid tax in another jurisdiction, doesn't mean that you don't have to file. You might be able to use the tax credits against potential tax in Thailand. So how and when to file? If you do meet the criteria to file a Thai tax return, then you'll need a tax ID number or a TIN. To obtain that, you can go to your local revenue office, or you can use a paid service like Expat Tax Thailand, who can obtain that on your behalf. For pensions, we need to file the PND 90 tax return, and that is from the 8th up until the 8th of April 2025. That's when we file for the current year. So we can file from the 1st of January all the way until the 8th of April. We've got a full online application and process for tax filing, so people can take the hassle away without having to deal with this themselves. And we can guarantee all the allowances and deductions. So we actually have 3 levels of service, so it depends on people's circumstances. Essentials for people with simple pension situations, assisted if they need to claim tax credits, and expert if they'd like us to take care of the whole tax filing process. So introducing the double taxation agreements. So we'll give a quick, brief explanation of what they're used for, and I'll explain some of the other webinars we've got dedicated for DTAs, and then we'll go through some common misconceptions. So what is the purpose of a double taxation agreement? Basically just sets out how assets are taxed if they are remitted to Thailand. And the double taxation agreement, the DTA, it takes precedence over local Thai rules, Thai domestic tax rules. So if something is stated in the double taxation agreement, then doesn't matter what it says on the local domestic tax rules, the DTA takes precedence over that. So for example, let's give an example. US DTA, it states that Social Security is not assessable income in Thailand. It's not taxable in Thailand. So even though pensions are taxable in Thailand, if you bring in Social Security, because it's named in the DTA as an exemption, that takes precedence over domestic tax rules. So it helps really see if there are any exemptions. That's the key for the DTA. And then it helps explain how things are taxed and how they can be taxed. Doesn't mean that you can't be taxed in Thailand, even if you're taxed elsewhere. But it doesn't mean you don't have to file either. So with the DTAs, we've got 61 with Thailand that have been signed. We've actually done all the research. Everything's online. All the DTAs are available on our website. I've done the hard work, so you could check those out. And with the specific webinars, we've got ones from UK, US, Australia, Switzerland, Canada, South Africa coming up soon, and then we've got a few more in the pipeline of France and Germany. If you do have any questions about your specific DTA for where your assets are, so it's not your nationality, it's where your assets actually are, feel free to get in touch, because we've done a lot of research on the majority of the DTAs, and we can provide you guidance for how they actually work. So let's talk about tax credits and how they actually work. So what is a tax credit? So depending on the double taxation agreement, it might allow you to claim a tax credit for tax paid in another jurisdiction. What does this mean? It means if you've paid tax in another country on your pension, depending if the double taxation agreement allows it, then it means you can, whatever tax is owed in Thailand, once you file, you can use the tax that is the tax you've already paid as a credit against the tax that's due in Thailand. So it could mean you don't have any more tax to pay. You just have to file. Could mean you have a little bit of tax to pay. They're the two options that it could be. You don't get a tax rebate back from the tax credits. It's a use it or lose it approach. So you really need to check the DTA with the jurisdiction for the assets of where they're based. So not your own nationality. It's to do with where is the pension, specifically for this webinar. Where's that based? What jurisdiction is it? And then look at the double taxation agreement between that country and Thailand and see if there are any special exemptions or special rules. It doesn't mean there's no tax to pay. It doesn't mean you don't have to file. It means you can potentially offset some of the Thai tax with a credit or all. So that's quite good. How are the assets taxed and what does the DTA say about these assets? So what I've done is I've gone through some of the most common questions that we get. So these revolve around US, UK, Australia, Swiss, Canadian, Netherlands pensions, then offshore pensions as well. And what I've done is we've gone through all of the DTAs and got the assessment for each one. And what I could do is just go through quickly how each are taxed if they are remitted to Thailand. So let's assume all of these are remitted to Thailand, so transferred to Thailand and you're a Thai tax resident. So let's start with the US. So US Social Security, that's not assessable income in Thailand. It's excluded in the double taxation agreement. That's quite favorable. That means you don't need to put that on a tax return. If that's your only source of income, you don't need to file. US government, so civil service pensions. So if you've got a civil service pension, then that is tax exempt and you don't have to file a Thai tax return because of the DTA. That's quite common for not just US, but most jurisdictions, that civil service pensions are not taxable or assessable income in Thailand, but you have to check the specific one. US 401k. So this works a bit differently to most other double taxation agreements. It shows that if that's remitted to Thailand, it's taxable in Thailand and you can claim back the tax in the US for that 401k. And for Roth IRAs, even though they are tax efficient in the US, if they are remitted into Thailand, they are taxable in Thailand. So UK, so the state pension is not excluded on the DTA, the double taxation agreement, and neither are private pensions or pension commencement lump sums. So if you remit any UK pension into Thailand, whether that's final salary, SIP, annuity, state pension, then it is classed as assessable income for all of these. But you can use any tax paid as a tax credit to offset some of the tax or all of the tax paid in Thailand. Australia, so superannuation, it clearly states in the double taxation agreement, if it's remitted into Thailand, it's taxable in Thailand. So it's classed as assessable income. And Australia age pension as well, if it's remitted, it's classed as assessable income. For Canadian pensions, they are all not assessable income. In the DTA, it shows that it's only taxable. They're only taxable in Canada. Swiss pensions, so Pillar 1, Pillar 2, Pillar 3, they are all taxable in Thailand if they are remitted to Thailand. So they are all classed as assessable income. There's no exclusions on there. Netherlands, same. So taxable if they're remitted to Thailand. They're usually not taxed at source for non-residents anyway. An offshore jurisdiction pension. So some people have pensions in Malta, Isle of Man, BVI, Gibraltar, for example. Any assessable income, if it's remitted into Thailand, is fully taxable, and there are no double taxation agreements with these countries and Thailand. So it means there's nothing to offset. So let's talk about some of the typical tax favorable pensions and investments that are not tax-free in Thailand. So these are some of the nuances. So we mentioned earlier the Roth IRA. If that's brought into Thailand, the pension distributions are taxable in Thailand as assessable income. UK pension commencement lump sum, so the 25% tax-free cash or tax-free entitlement, and UK ISAs, well, they're not tax. There's no exemption in the double taxation agreement, so it is assessable income if you're bringing the tax-free lump sum into Thailand. Superannuation in Australia, same as the UK PCLS. There's no exemption on superannuation, so it's just classed as pension income. If you bring that into Thailand, it needs to be added to the tax return as income received. And offshore jurisdiction pensions, so some of those are quite tax favorable. For example, Gibraltar at 2.5% tax. Well, the problem is there's no DTA in place, so you'd have to pay the tax in Thailand as well if it's remitted to Thailand. So for all of these, they're only if they are remitted into Thailand. So let's go through some of the common allowances. So once you've worked out if your pension is taxable or not, or pensions, which ones are and which ones aren't, which ones are assessable income, then what we need to do is we need to work out the allowances and deductions. So everyone gets 60,000 personal allowance. If you're married and the spouse doesn't work, then you get another 60,000. Child allowance, so 30,000 for the first child and 60,000 if the second child's born after 2018. And this is if they're in full-time education. Health insurance, so if you've got Thai local medical insurance, not an international plan, then you can deduct up to 25,000 Thai baht from the premium. And life insurance, it's capped at 100,000 if you've got Thai local life insurance with a term. If you're over 65, you get another 190,000 allowance as well. And then for pensions, you get another 100,000 allowance on top of all of this for remitting in a pension. So then once you've worked out if your pension is taxable, and then you've worked out your allowances and deductions and taken those off, that's when we look at the tax brackets. So the tax brackets, the first is a progressive tax system. First 150,000 is tax exempt. Then the next 150,000 is 5%. And then it goes up through the brackets all the way up to 35%. So I thought what we could do is go through a few case studies and then actually look at different scenarios. So we'll look at someone who's got a tax filing obligation, but no tax. So someone with a reasonably low income. We'll look at someone who's bringing in non-assessable income in pensions that are remitted to Thailand. And then we'll look at someone who's got a mixed bag of pensions that are assessable income in Thailand. So it will help answer a lot of the questions that we've had in. So first scenario, someone with a relatively low income remittance. So a 65-year-old married with a Dutch pension. So they're retired in Thailand, live over 180 days. The Netherlands pension could be switched with pretty much everything else apart from the US where it's slightly different. So they're bringing in, for example, 500,000 Thai baht. So this pension, they are remitting, transferring into Thailand, or they're using a foreign ATM card with this pension money in that account only. And they're drawing the money from there. It doesn't matter either way, still classed as remittance. Now, because of the allowances and deductions for a 65-year-old married person, their allowances and deductions are 410,000, plus the first 150,000 is tax exempt on this table. So what does that mean? It means if someone was bringing in 500,000 Thai baht and they meet these criteria, so they've got all these allowances and deductions, then they need to file a tax return because they're over that 220,000 Thai baht, which is the minimum that anything over that you have to file. But it's likely they don't have to pay any tax. So we have an essential tax filing service for that. So people who need to file, but they don't have a tax implication. They have to just a tax filing obligation, not a tax implication. Let's go into case study 2. So someone who's got non-assessable income. So same person, 65-year-old married. They've got US Social Security and a Canadian pension only. They're retired over 180 days. They're bringing in 2 million baht a year from these pensions. So both of these pensions are not assessable income. They are not under the double taxation agreement. They're both exempt. So that means if they didn't have any other source of income apart from these two, then they don't need to file a tax return and they do not need a tax ID number. So we only file if you have assessable income and it is over the minimum limits to file, whereas US Social Security and Canadian pensions are not, don't fall into that bracket because they're not classed as assessable income in Thailand. The third case study is where it's a little bit more complicated. So it's the same person. They've also got a Roth IRA, Australian super, UK state and private pension, and a Netherlands pension. So they retired 180 days in Thailand and they're bringing in 500,000 from each jurisdiction. So they're bringing in 2 million Thai baht per year from these jurisdictions. Now, on this example, all of these pensions are assessable income. So what does that mean? It all needs to be added onto the tax return, but they can use tax paid elsewhere as a tax credit. But this example is only really for these pensions. The only one that's taxable is the UK one. So we'll assume that the UK pension is larger than what they're bringing in. So they're bringing in 500,000 Thai baht, but we assume that they're getting £30,000 overseas and they're only remitting in 500,000 of that. So then we can work out how the tax credits work for that. So how it works is we add up the full income, 2 million Thai baht, use the allowances and deductions, calculate the tax, and then we can deduct off the tax that's been paid as an apportionate amount for the 500,000 that's been brought in from the UK pension as a tax credit. So this is how it looks. A bit small on the screen, but I'll explain it. So 2 million baht, they've got 410,000 of allowances. So it's 1.59 million Thai baht. You go through the tax tables and the tax owed is 262,500 baht, about 13%. But then because of the UK tax that was paid at source for the UK pensions, we take that tax credit off there, which is £58,000. So total tax would be 204,000 for this example. Now, we do have a free tax calculator service where we can run through with your own situation to calculate how much potential tax you may have to file, or if you have to file at all. If you'd like to use that, then feel free to click the link in the email that we'll send out after this, or in the link below if you're watching this online. You can book in a free 15-minute call with my colleague Jason to actually run through your own tax calculation if you'd like. A lot of people found that very useful. We're happy to help so people can understand how it looks for their own situation. We also offer tax consultations. So if a quick 15-minute call is not enough and you really want to go into the detail about your own situation, we offer one-on-one paid consultations to actually work out your own situation, how it looks for yourself, and actually do some planning as well. And feel free to book in for those. So how will the Revenue Department actually know? And what is common reporting standards? So Thailand actually signed up for common reporting standards in 2020. What does that actually mean? So automatic exchange of information is something that was actually put together from OECD countries, and Thailand actually signed up in 2020. What it means, it's a free flow of information and automatic exchange for all of the revenue departments who've signed up to common reporting standards. For the US, they use FATCA reporting, which is slightly different. And the information is distributed for tax residents to the other common reporting standards countries via their revenue department. So it actually started in 2016, but Thailand actually signed up in 2020, and September was the first time that they received the full set of information from all of the other common reporting standard countries. So if you're a Thai tax resident and you've got assets, say UK and Canada, Australia, Singapore, Hong Kong, then the information's relayed back to the relevant revenue department, and then that's sent on every year in an XLS file to the Thai revenue department for all Thai tax residents. It's really a global initiative to stop people avoiding tax. That's why there's talk about future talks about turning into a worldwide taxation basis. Now they have full access and are able to see the transactions through accounts. So anything from bank accounts, credit cards, pensions, investments, even insurance-based investment products, all this information is relayed, account balance, transactions ins and outs, account name, number, is relayed to the revenue department every year. And then it's relayed from that revenue department where the jurisdiction is to Thailand every year. So this also tracks ATM, credit cards, and the information's fully available now to the revenue department. So it's not just on your tax return where you state the information, then they can double check. They actually receive the information direct as well from the other revenue departments. So exactly the same as all other revenue departments and tax authorities, the penalties for non-compliance is pretty harsh. There's a surcharge of 1.5% per month for every month since the tax was owed if people don't file a tax return. Also, if they don't volunteer and pay the tax and they are actually found that they haven't paid the tax, then they can have a penalty up to 200% of the tax that was owed, plus the 1.5% per month. And also up to 200,000 baht fine, plus up to 1 year in prison. So pretty standard for tax authorities to have harsh penalties. So let's go through some pension tips and a bit of advice. The key is really to calculate what the potential income tax is for yourself with the different asset classes. For pensions itself, you really need to check the double taxation agreement if it's not one of the ones I mentioned earlier, to work out how they are taxed in Thailand, if they are remitted, transferred to Thailand, and to see if there's any tax credits that are available. If you have got a tax credit, can you use that with the double taxation agreement? Yeah, potentially then we'd file that for our assisted filing and use the tax credits to offset the tax. It's important to keep a good record and keep track of all the transfers that you make into Thailand, because we need to file at the end of the year to show exactly what has been brought in. And also if you need to offset that with credits. Just remember, we are here to help. It's complicated and complex. If you've got any questions, feel free to reach out. It's what we do all day, every day. So we can help, like I mentioned earlier, with the free tax calculator video calls. Also, the frequently asked questions page is very useful for people to, we've got a lot of other videos and webinars on there as well. If people do need a one-on-one consultation, you can book through the website. And we do help with tax filing. That's our most favorite service, is actually helping people file the taxes on their behalf and helping them to obtain Thai tax ID numbers, which some people have been struggling to do with their local revenue officers. We can help with that. Also, we've got guides that are available to explain how the new tax rules work. Might be quite useful. And if you do want to take advantage of that 15-minute strategy and tax calculation call, feel free to get in touch. Also, I think it's important that people sign up for the tax alerts. So it looks like there are going to be further changes to the income tax rules. Whether that moves into how it looks on worldwide taxation, we don't know, and we don't know when. All we know is that we're at the forefront of this. If you sign up to our tax alerts, then we'll make sure that you are kept up to date with any future changes. So with our online tax service, tax filing service, everything can be done remote. Just fill out your main details and we do everything else. We can actually help with claiming tax credits back. We can file for simple cases where you just need to file and there's no tax. and we can help with really complex cases as well. So we've got a package available for each type of person that needs to file taxes in Thailand. So we'll get on to the Q&A. We've had quite a few questions that have come in already. So we'll start with a few of the questions that have already come in. I've actually put some of them on here already. So question 1, I'm considering moving to Thailand. I have 800,000. I have to transfer 800,000 Thai baht to a Thai bank. Do I have to pay tax on that? Also, I pay the rent and living expenses with the card from either Australia, Switzerland. Is this still taxable? So this all depends if they were a Thai tax resident in the year that they remitted in the 800,000 Thai baht and where the source of that money is. So if the 800, let's assume they haven't remained in Thailand 180 days in that year, they can transfer what they wish into Thailand. That's not assessable income. If they had stayed 180 days or more, then we have to look at where's the source of that 800,000 Thai baht. That depends whether it's from pensions. If it was from cash from previous years, then that's not assessable income. If it was from tax exempt pensions like Social Security, for example, then that wouldn't be assessable income. But it mentions on here Australia and Switzerland. So if it's from a super or a Swiss pension, then it may likely be taxable in Thailand. If I remit UK monies to a builder in Thailand, would this be tax accessible for me or the builder? So let's assume that someone remits, so transfers money from overseas into Thailand as a Thai tax resident. If you send it to a third party, it is still you remitting the funds into Thailand. It's not the builder's liability. It's actually your liability still. It needs to be on your tax return. And it depends on where the source of the money is. If it's cash from previous years, then that doesn't need to be filed on a tax return. If I remit UK savings to my Thai bank 30 months prior to becoming tax resident, would this be tax accessible thereafter? No. So this basically just explains, someone's asked if they bring money into Thailand when they're not a Thai tax resident, is it accessible income? No, that's not the case. So we've got a few other questions that have come in. One I've had today, I went to the revenue department to ask for the form to apply for a TIN, and after much toing and froing, I was told it wasn't necessary to register. So yeah, people have got to be quite careful if they go to the local revenue office, that they've got to make sure that they can justify and prove that they do have tax to pay in Thailand. Now, if they do meet the criteria, so let's get it on the table here. If they do meet the criteria for filing, so they bring in, let me find the slide. I can talk through it a little bit. This one. So if you do bring in 240,000 as a married joint filer of assessable income, pension income, you need to file a tax return regardless if you've got tax or not. That's really what you need to justify to the revenue department to show that you do have tax to pay, and you do need to file. If people are struggling to get a TIN, tax ID number, we can help with that. We do have a paid service to obtain that on people's behalf. Right, okay, I've got another question. I've got several pensions paid into my UK bank account. I transfer the money to my Thai sterling bank account, and when I need it, I take it out. Had a balance of approximately £35,000 in my UK bank statement as of the end of last year. So far this year, I haven't transferred any money to Thailand. I believe that at the end of the tax year, I'll transfer £10,000 all. Am I correct in thinking that none of this is subject to tax? Okay, so this question is about commingled accounts. So if you've got a commingled account, which means you've got some cash in the bank from previous years, some income that's been paid into there, you've got to do the calculation yourself. It's better to separate out a mixed account so that you can clearly show and demonstrate that the money was from whatever source is in there. So if it was from pensions, or it's from cash in the bank from previous years, or inheritance, for example. But if you can't do that in a commingled account, what we use is the first in, first out method. So we look at the account balance when you remit the money to Thailand. Could you justify that the money, that was there in the previous tax year is still in that account? If you've had a lot of money assets come out of that account and it can't be shown, and you've already spent that money, then it can't be. If you've added money in since then to top it up, that doesn't count. That would be assessable income. So really, if you've got a commingled account, you've got to really do a bit of analysis on there. There's a bit of work to do with that. So look at some of the questions that have come in. Okay, quite a few. So let's go on to this. So will the tax on the 25% tax-free allowance on UK pensions be treated in Thailand? Okay, so another UK question. So as I mentioned earlier, the double taxation agreement doesn't state anything else other than pensions are taxable in Thailand. So what does that mean? It means that if that's remitted into Thailand, regardless if it's tax-free in the UK, it's still pension income. So it is assessable income. If anything like register, let's have a look at some of these questions. Yeah, one question about US Social Security is not taxable. Yes, that's right. Let's go through to the last questions. Some of these came in early. Okay, if you transfer 2 million Thai baht into your wife's Thai bank account in March 2025 to buy a condo in her name, how is this calculated? Well, okay. If you transfer the funds into Thailand to whoever you wish, it's still your assessable income. Do the previous year remittance rule apply in 20? Okay. Does the previous year remittance rule apply for 2025, i.e. money made in or before 23, not taxable? So, David, this is the thing that actually changed in Thailand, is the rules changed on the 1st of January 2024. That's when the rules were updated in terms of to overrule that previous ruling. So now if you're a Thai tax resident and you stay 180 days or more, if you're remitting foreign source income into Thailand now or any time in the future, it's assessable income. You can't leave the money overseas for 1 year and then bring it in like you could before. So I hope that answers that question. Okay, I only have income from 2 state pensions, UK and Ireland, and 2 private pensions, UK and Ireland. Are they assessable income if I bring in to Thailand? Yes, both are. Well, all 4 assessable income in Thailand. You can use your allowances and deductions in Thailand to offset any potential tax. And you can use the tax credits to offset any tax and the allowances and deductions in Thailand. I deposited money from an inheritance into a superannuation and term deposit. Why is this not exempt? So okay, good question about inheritance. So inheritance is not taxable in Thailand. But if you move that inheritance into another structure, so a pension or investment, then you follow the rules for that new structure rather than it was initially inheritance. So we have to look what you've invested the inheritance into. If it's still in cash in the bank or it's in a fixed deposit, then that's not assessable income if brought in, if you don't bring in the interest from the bank. We'll look at a few more questions. So that's the slides distributed. Yeah, we'll send out a copy of the recording and the slides separately. Yeah, okay. One question about using a US ATM or credit card instead of Thai cards. Roth income partially remitted to Thailand, travel to a third country, it appears it's best to use a ATM instead of Thai cards. Now, if you use, I think this question's getting at cash, bringing cash to Thailand. If you bring cash into Thailand, it depends again on the source of that cash. It still needs to be filed on a Thai tax return if it is from foreign source income. If you're using an ATM or credit card and you are using what we class as foreign sourced income to pay off credit card or is on the ATM, then that's assessable income as well. Someone asked about the pension income allowances. Yeah, 50% deduction up to 100,000 Thai baht. Yeah, so with the allowances and deductions for pensions, you get up to 100,000 Thai baht allowance for that on the pension. So I hope that was answered in the slides. Do I still need to register a local tax office even though I'm only bringing in US Social Security? No, you don't need to file a Thai tax return. If you don't need to file one, if your only source is non-assessable income, so for example, in this situation, US Social Security, then you don't need to file a tax return. It means you don't need to get a tax ID number if you don't need to file. You only need to get a Thai tax ID number if you have a Thai tax filing obligation. You might not have tax to pay, but you still might need to file. But in that case, if it's not assessable income, you don't need to file. A question about double taxation agreement and UK government pensions. So civil service, police, NHS, they're all tax exempt in Thailand. They're classed as government pensions. Okay, I have a question about money. If money's brought into Thailand for repairs to your home, or you have it in a company name, is it assessable? So yeah, good question. So it doesn't really matter what the purpose of remitting the money in is for, whether it's for hospital bills, you pay direct to a hospital or to a third party for house repair, you're still remitting the funds in, and all we care about is what's the source of the money that was remitted into Thailand. Is it pensions? Is it investment capital gains? Is it original capital and you haven't made a gain on your investments? So it's really important that we look at that side of things. What's the source? Okay, according to the criteria, I do not need to file a tax report in Thailand, but still my bank in my home country asked me for a Thai tax ID. Yeah, so and I've had a few questions like this. If you don't have a Thai tax filing obligation and you don't have Thai tax, you don't meet the criteria to apply for a Thai tax ID. So if you don't, so that's the point. If you've had a bank or institution overseas saying that you need a Thai tax ID number, you don't need one. You can actually say to them, if you don't have tax to pay in Thailand, if you don't have to file, you don't need a Thai tax ID number, and you can't actually get one. So you can actually tell them that it's not possible to actually explain these reasons. If you'd like discussion about that, I can help with this. Okay, good question here. I'm a Thai tax resident. My Thai address registered with the UK government pension, but my pension is still paid in the UK bank account. I don't remit it to Thailand. I only remit earlier savings, so should not have any filing requirement in Thailand. How does this interact with CRS, which may report that income? So yeah, it's a good question. If you're not remitting in your pension income into Thailand, you don't need to file a Thai tax return. If you are spending cash from other sources that's not assessable income, you don't need a tax ID number and you don't need to file. And even though the data might be sent by common reporting standards, it's fine. You just need to keep a very good record to show that the money that you are remitting is from cash from previous years. Yeah, one question about if you're tax exempt, you need to file a tax return. We've answered that. If I qualify and I have an LTR visa, do I have to file a tax return? So with the LTR visa, the long-term residency visa by BOI, then the stipulations on there show under the revenue code that income from, if you have the LTR visa, foreign source income is not assessable income in Thailand if you remit it in the following tax year. So it follows the old rules. If you have the LTR and you bring in income in the same year that you earn it, then that's still assessable income. So you'd have to file a tax return and there'd be potentially tax on that. But if you do bring in the income in the following year, then you wouldn't need to file a tax return because it's not assessable income. Look if there's any more questions that have come in. If I leave Thailand before reaching the 180-day limit, can I bring money into Thailand without worrying about paying tax? So, yeah, good question. So let's talk about a few scenarios where there would potentially be tax. So if you were in Thailand and you were getting a salary in Thailand, or you had rental property income in Thailand, and regardless if you are 180 days or less or more, you'd have a Thai tax filing obligation. Also, if you were working for an overseas company in Thailand and the work was being conducted in Thailand, so then that could be classed as assessable income and could be taxable in Thailand. But for most of the scenarios, I assume this is where this is actually leading. If you are under 180 days, you can remit in foreign source income into Thailand, and it's not assessable income in Thailand in that year. So how about annuities in the US? Yeah, annuities are assessable income in Thailand. So look at a few more. Okay, retirement and marriage visa require showing income or money in Thai bank. Is there any proposed tie between revenue? So and the revenue and so let me reposition that question. So the question was around: is there a link between the revenue department and immigration? And do they know the amount of days that you stay in and the marriage visa showing the income that you're bringing in? Yes, they do. So there's a computer link program between the two. Also, with this new electronic visa system, it's going to be very easy for immigration to be able to know how many days people have remained in Thailand. It's going to get more and more easy for the information to be on the revenues desk. I think that was the question: is there a link between the revenue department and immigration? Yeah, there is. Yes. Okay, one question about Australian supers. So it's already been taxed, 15% tax paid on all contributions and gains before. Can this tax be claimed on this? No, it can't. So it's the same as if you had a UK pension and you've actually there's no exemption or reduction on there for the tax that was already paid. If your super was taxed when it was paid out, then yes, but that's not the case. So it's one of the ones that's been caught up in this super where it is assessable income if brought into Thailand. Someone else mentioned about examples that pension remitted can be deducted up to 100,000 Thai baht. Can you explain this? Yeah, it's just one of the allowances deductions for, I'll explain it in a bit more detail. So it's section 40, part one. So that's where pensions fall in, and actually you get 100,000 up to 100,000 deduction from there if you are bringing in or you have this type of income. So it's just an extra deduction. It's only 100,000 Thai baht. Okay, on the another question on the 180-day issue, theoretically, you can leave Thailand, say for a week, and then come back to Thailand. In that scenario, can you bring money into Thailand without tax commitments? Don't really understand the question. So I think what it means is if you if you're under 180 days in Thailand, then you can remit or transfer money into Thailand without any tax implication, as long as it wasn't earned in Thailand. Um, that's in a calendar year. So if you do leave and then come back, well, if you've 180 days in the year, then that counts. It's not continuous days, just from a calendar year. yeah, I think that's pretty much all of the questions that we've had in. If I haven't answered the question or you've got any more, feel free to get in touch. I'm here to help. I'm easy to get a hold of to go through this in more detail. If you'd like to look through the DTAs, they're all on our website. If you've got any other questions, feel free to get in touch. So thanks for joining. I appreciate your time. Thanks for putting up with this man flu that I've got. Hopefully the next webinar, I'll be a bit more fitter. So thanks for that. Bye-bye.